Hello, California, and welcome to this week's edition of Your Financial Compass, the show that's dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio are two members from Bulman Wealth Group. We have Chris Bulman, who is founder and financial advisor Chris Vlahon. Chris, Scott, it's so good to see you. How are you this week?
Good to see you. You know, it's I just want to start this show. We're going to be talking about the urgency of financial planning, and here in the studios today, probably they could have had some urgency fixing the restrooms over time.
Yes.
But if you wait too long, then there's a problem. And sometimes in a financial plan, we have the same thing.
I didn't want to lower the level of humor to potty humor like Chris, so I haven't joked about it all day. He can't stop.
But yes, it's a situation we're navigating.
Yes.
But this is a great segue because, to Chris's point, there are so many unknowns that happen in our financial lives that we have to be prepared for. We don't want your financial future to be flooded in not a good way, right? Like
That's
the bathrooms
right.
are today.
Wow.
So.
Okay,
That's a good one.
Let's keep battering that one.
Right? Oh, man. Well, specifically today, we are going to be talking about your qualified accounts. And the way I like to think about it, qualified accounts mean that they are qualified to pay tax on, that you've been kicking that can down the road and you're going to have to eventually pay tax on those accounts, right?
Yeah.
And so one of the things is recently an article came out in July of 2023. It was in Investment News, and the title of the article really stopped me in my tracks because it said, stop contributing to your IRAs and 401ks. And it started off by saying this: stop contributing to your IRAs and 401ks, that has to be a typographical error. After all, traditional retirement planning has always preached maximizing contributions to tax-deferred individual accounts and 401ks to build retirement savings. And the article went on to say that these decade-old strategies that have worked in the past are no longer working today. And actually another article came out that was kind of speaking in relation to that as well. So before we dig into this, I'm just curious to get you all's, your perspective on this. Why would someone out there actually suggest that people should stop contributing to their IRAs and 401ks?
Because they want to write a clickbaity title to get you to read it and be like, wow, what do they mean?
The shock value of it,
there's
right?
some shock value to that. And, we've talked on previous shows, dealing in absolutes in the financial realm is erroneous and kind of silly. Obviously, there's probably a lot of truth to that, and you can make arguments for and against. I'm not going to jump. Yeah, absolutely, you need to. It goes so much deeper than that, as we will get deeper in today in terms of a Roth 401k, non-Roth. But going back to just what does a qualified plan mean? I guess you kind of already explained it, but I don't like that title. I think it's a bit much.
Well, I think a comprehensive financial plan should be able to give you a path of what you should do.
Right.
So if we, scroll back or roll back the clock a bit, before we had all these statistical or stats that we can look at and softwares that we can use. You even go back in baseball, if you've ever seen the movie Moneyball, which I know Scott has
great
seen.
movie.
Read the book too.
100 times. So if you look at that, you used to have a bunch of guys in the room going, this guy is bad and this guy's good and we should, make an offer to this one, we should recruit this one. But then Moneyball came along and they started looking at the actual statistics that show why you should have go in a certain direction, why you should have multiple players that are more average or above average instead of one superstar, for example. And when you start to be able to compare the statistics, that makes a big difference on what you actually do. And then the old sort of the old rule of just having guys that had opinions, that sort of went out the door. Now it's opinion plus statistics.
Right.
It's the same thing in the financial planning world where it used to just be do this because, Warren Buffett says so or something. But now we can use the statistics. We can look at a comprehensive financial plan that uses software to look at different scenarios. And we can say, well, should we continue to maximize our 401k, our IRAs, our qualified plans? Should we do that? Or should we read this article and say, what about a different direction? And if we go in the different direction, what does that look like?
Right.
And the great thing is we don't have to just have an opinion and try to sell you in a direction. We just look at the numbers, and the numbers will give us an idea of which direction we should go.
They really do speak for themselves and show you the options of, okay, you can do this or you can do that, but this is going to be the result. Now, I think what's interesting is that when these tax-deferred accounts were created, they were sold to all of us as this was a good thing. You get to defer paying the tax because then when you're in retirement, hypothetically, you should be in a lower tax bracket. And I think a a lot of folks think, well, isn't that the case? Isn't my income going to be lower in retirement? So what would you say to someone who's of that school of thought?
I would argue that it's a myth at this point. It makes sense when you think about, oh yeah, my income would be less taxes. But from what we found with a lot of our clients, that's not the case. Genuinely, you get to that point, like, well, golly, taxes are higher than they've ever been. And there's a number of reasons. Sometimes it's maybe you've been contributing into a work-related 401k plan for years. That's gone. Paying into health insurance, that's gone. Maybe you're on social or Medicare. Your write-offs get less. So generally, you're actually, in some instances, making more than you ever were because all those deductions are gone.
Right.
And then, as we've talked about on previous shows, the ever-revolving, tax structure and tax rates from the government and the IRS, if that keeps creeping up as well. So it's a long way of saying that's not always the case. In most cases, people are paying a little bit more in taxes than they ever thought they would.
Right. Well, and even last week we did that entire show on RMDs and how can be that shift even if you retire in your 60s, but all of a sudden you hit RMD age. Well, now your income is going to exponentially go up because of those RMDs, and then that can potentially create a greater tax bill as well.
Yeah, and the answer to all this is a comprehensive financial plan, right? So if you have that plan and you can see what's going to happen in the future. For example, if we knew that you lived in Michigan, where Scott's from, and I lived there for 1 year. But if you lived in Michigan and you knew that about September, October, the clouds roll in from the lake effect, and you don't see the sun again until April.
Oh yes,
right?
It's brutal. I have been there during that time of year.
Right.
And the roads are always bad. That's all 12 months.
But if you knew that, and you knew you're going to get 6 feet of snow starting in Kalamazoo, and then it just keeps going across the state, maybe you want to start looking at having a 4-wheel drive vehicle or having a self-starting heater in your car.
Yeah.
You want to kind of know things in advance. And again, that's what a financial plan can do for you. Is we can take a look at your current situation, your income streams, your expenses, your budget, your taxes, your volatility, all the different things that can go into it, and put all those puzzle pieces together. Actually show you the completed puzzle and what it might look like in the next couple of years. And if that's something that you've been curious about, click the link at the bottom, call the phone number, and schedule an appointment. We'd love to help.
Wonderful. Well, Chris Scott, I know you love serving the folks of Northern California and throughout the state, and you have other clients in other states as well, and this is a great opportunity for them to connect with you. So we encourage you, if you would like to take advantage and get your own complimentary financial compass review, simply call that number on the bottom of your screen, 888-970-4685, or you're welcome to take out your smartphone. Simply scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and a member of the team from Bulman Wealth Group will reach out to you to schedule your complimentary visit that way as well. More on this discussion of how to navigate your qualified and tax-deferred accounts right after this.
The team at Bulman Wealth Group is exceptional. From our advisor team to our service team, which is, I think, second to none. We invest a lot into that part of our office as well, because we want people to know, how we feel about them. But it all revolves around the idea that our clients are vitally important.
There's so many different financial advisors. There's so many folks that they can choose to work with. So one of the ways I feel like we differentiate ourselves is we want a relationship with our clients. And, I really learned that from Chris is there's so many dollars and cents and all this information to know. But at the end of the day, it's got to be a trust and a like because we're partnering with somebody. So I want them to think a trip to see me is not a trip to the DMV or to the dentist, but it's just being able to share in the good times and be available to be a resource in the bad times too. So at the end of the day, just boiling it down to the relationship is really important to us.
Welcome back. You're watching Your Financial Compass, brought to you by the team of Bulman Wealth Group. I'm your host, Kristen Oakley, here with Chris Bulman and Scott Vlahon. Chris and Scott, that can be a tongue twister for me sometimes, right? But so glad to be here with you today. And we're having a really important discussion of knowing what you should be doing with your qualified accounts. The reality is that the majority of Americans have amassed the bulk of their wealth into workplace retirement plans, things like 401ks, 403bs, TSPs, 457s, or IRAs, a combination of both. Often, as we've talked about, a lot of people have multiple accounts. Right. And so before the break, we talked about the problem that this is presenting for people because it increases your future tax bill in retirement. What are some possible solutions that folks can utilize to navigate this?
Well, one of the big ones is the ability to do a conversion from your traditional accounts to Roth accounts. And what I love to do with people when they come in to see us, we can take a look at the tax bracket you're in currently, and how much more income can you take in that current tax bracket without pushing you into the next one. And the reason we do that, if we have cash on the side, for example, is we can go ahead and begin to convert some of those traditional dollars into Roth dollars from forever taxed into never again taxed, and use money that we have in our cash accounts to pay those taxes. That's an absolutely brilliant strategy, depending on what age and what your income is. There are certain people that's not going to be a good idea for, but as long as you're doing the math, you're running it through our illustration software, and we're able to look at, if we convert that money from traditional to Roth, of course, we're going to pay a little bit more taxes now, but we'll pay less for the rest of our lives.
Right.
And so depending on where we are in our lives, in our 40s, 50s, 60s, the answer could be one or the other. But that's why it's important to sit down with someone and find out the exact answer for you.
Well, and to your point, I know you work with a lot of folks who are still working, and you work with a lot of younger clientele as well. So what would you say to someone who maybe has grown up with this way of thinking of, the best thing I need to do is put as much money as possible in tax deferred and get the tax break today, but they're concerned that if they engage in some of these other strategies, that they're going to lose that tax deduction today? What would you say to someone who's wrestling with that? Yeah,
we've heard that a lot, and it's one of those things, you're going to pay taxes now or at the end. So you choose when you'd rather pay them.
You can't get out of it, right?
Because the one moving target is the tax rates. The current tax structure ends at 2025, end of 2025. It'll change 2026 and on. We don't know what the rates are going to be. They're going to be higher. Surprise, surprise. So I would say, well, if you're saving on taxes now when tax rates are relatively low, you're just deferring them and all the growth for many years from now when you're pulling money from those accounts and tax rates are higher. So I would say I'd rather pay the taxes when it's going to benefit me the most. Get them out of the way now. And that's where we've talked about this before. Chris referenced Roth conversions. More and more companies are offering Roth 401ks.
Yes.
I don't know what the percentage is, but we're seeing more and more companies offering them. And what that means is, if we have a Roth IRA is something outside of work. And there, if you're over the age of 50, you can only contribute $7,500 a year. If you have a Roth 401k through your workplace, if you're over the age of 50, you can do $30,000 a year. The contribution limits are so much higher, but you're getting the taxes out of the way now. You pay them now. Everything you put into that Roth, plus all the future gains, are tax-free. In my opinion, it's the most powerful tool in terms of things to put money into, because it's really immune from what those future tax rates are going to be. So we always say that, find out if you're watching this, go to the office this week. Hey, do we have a Roth 401k? How do I get started? If we don't have one, why not? Let's get one started. But check there first, and you're paying the taxes now, and it's just getting one less thing to worry about in the future when we know tax rates are going to be high.
Yeah, and just to add on to that, Scott, if you're, let's say, 30 years old or so, and you're going to plan on investing in your 401k and a traditional IRA over the next 30 years, you're going to save maybe $5,000, $6,000, $7,000, $8,000 a year in taxes.
Right, because you take the tax deduction today.
Right, you take the tax deduction today and you save that. But if you do that times 30 years, maybe it's $150,000, $200,000 you saved over those 30 years. Well, guess what? Now you get into retirement. Maybe you're 73. You have to start taking those distributions. If you've built a sizable IRA, you'll pay all of that $150,000 in taxes back in the first about 5 to 6 years. But the downside is you get to keep paying them for the rest of your life.
Yeah.
Now, flip that to what Scott was saying. Well, what if we had a Roth 401k or Roth IRA instead? We would have gotten those out of the way along the way, and we never owe taxes again. So when you do the math, it can be a substantial difference in the amount of taxes you pay depending on which direction you choose.
There's an analogy we use sometimes about apple seeds. And here, I'll try to eloquate it right now. So say someone gives you a bag of apple seeds, or like, give you two options. One, give you this bag of apple seeds and I'll tax you, or you can plant it. So you save taxes now, plant the seeds. I'm going to tax you on the orchard. So everything that grows, that's option one. Option two is I'm going to tax you on the seed now. You plant it, all the orchard is yours. I always give that example and say, what do you like? Well, I like option B. That's a Roth. And everyone's like, oh, well, that makes sense. And just get them done with now.
And it's not just the orchard, it's the fruit that it bears forever for the rest of your life is tax-free. And when it passes along to your children as well.
Yes, and that's an important thing because I think a lot of folks, if they've been engaging in this tax-deferred strategy, as so many of us have, because that was what we were told back when all these accounts were first created, the trickle-down effect is now when people are, leaving money to their loved ones, they're actually, what the beneficiaries are inheriting is a ticking tax time bomb, if you will, because then that tax liability gets passed on to those who inherit it, and that can be a big problem.
It can be a really big problem. And if every decision that you make, whether it's a stock to buy, I like Tesla to talk about because it's one that's grown like crazy, but you lost 70% in 2022.
Right.
So there's always good and bad about everything, including strategies. And so as long as you understand, the good thing about a Roth IRA is it gets to go tax-free forever. The bad thing is you have to pay the taxes today.
Sure.
The good thing about a traditional IRA is it's tax deferred and you get to write it off. The bad thing is the government's your partner. And when the government's your partner and you turn 73, first of all, they get to tell you when you have to take it. And they get to tell you, think about it, if you're 50, what are taxes going to be in 23 years? They're going to tell you, and they're going to tell you what % partner they are.
Right.
So it's really important to understand those. And then you make your decision. Do I want to do Roth? Do I want to do traditional? Do I want to do life insurance? Do I want to do a non-qualified account so I have access to it whenever I want? Lots of different answers. And if you've been struggling with these questions, struggling with these answers, that's what we're here to help with. So if it makes sense for you, you want some answers, give us a call at the number on your screen, click the link in the lower right hand, and we'd love to help.
Wonderful. Well, Chris and Scott, thank you so much. To our viewers at home, again, that number to call is 888-970-4685, or you can take out your smartphone, just scan that QR code in the bottom right-hand corner. That will take you over to that landing page and get you connected with Bulman Wealth Group as well. More on today's show of to contribute or not to contribute. That's the question when it comes to your tax-deferred and qualified accounts. We'll cover some more important questions right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Well, welcome back to Your Financial Compass. I'm your host, Kristen Oakley, here with Chris Bulman, Scott Vlahon from Bulman Wealth Group. We are having an important and lively discussion, I might add today, about the different types of accounts that folks have been accumulating wealth in for all these years. And the majority of Americans do have most of their wealth in tax-deferred accounts, and that creates some complexities and problems that we now need to navigate with our current economic climate. So I know you mentioned Roth conversions are often a great strategy for folks. I want to talk about both the pros and the cons. When is it a good strategy for someone versus when it might not necessarily be the right fit for someone?
Well, it can be a good strategy. I think the younger you are, it's a good strategy to try to invest as much as you can into your Roth because you have all those years. Remember, when you do a traditional 401k or a traditional IRA or any of those types of tax-deferred qualified accounts, you have a partner in those accounts. So when you look at your statement and it says $750,000, that is not your money, Kristen.
Right.
It is part yours and part of the government's.
Yep.
And again, you're the minority partner. The government is the majority partner because they get to make the rules. They get to tell you when you have to take it. They get to tell you how much tax they want to keep from it.
And they can change the rules at any time.
And they can change the rules
They
at any
can
time.
and they will.
And they will.
And they will.
Absolutely.
So
Yeah.
it's important to understand that. But I think the younger you are, as you're building your income stream, it's important to understand that the long-term effect of your choice today, what it's
Yes.
going to be. Because we see a lot of people in their 40s and 50s going back even already and converting those traditionals into Roth.
Yep.
So I think that's important to think about. I think if you're in your 60s, you maybe have a couple of $100,000 in your traditional 401k or IRA. It's probably not the biggest, important thing to convert to a Roth IRA, because you're already not going to be in the highest income bracket based on your RMD, and so it's not going to bump you up to another level. However, some people just want to get it out of the way, and so they want to convert. But it's not always a definite answer. You should do a Roth conversion.
Well, and that's why it's not a one-size-fits-all strategy
Never.
either. And you have to really sit down in the financial planning environment to figure out what's right for you, because you aren't like anyone else. And this is a personalized, customized process of really figuring out what strategy someone should employ.
And I always tell people this, what's the best account? The best thing to do is save, period.
Yes.
Save period, then you start to figure everything out. And another thing we haven't referenced yet, but think of this, if you're still working, we haven't referenced company matches. So think of it, when a company matches, say they're matching 4%, let's just say 5%. You have to put in 5 to get 5. They will, 99.9% of the time, that match will be into the traditional 401k.
Yes.
So I always say, try to contribute up to the match, then look into, because that's free money.
Right.
Period.
Yeah. Otherwise, you're leaving it on the table.
Yeah,
so
that's
it's
free
never
money.
smart to leave that out. Right.
So, but what I'm also trying to say is the match won't be into the Roth. That would be phenomenal. Chris can you start doing that at Bulman Wealth? Matching, that would be awesome. Because there's no benefit tax-wise for the employer to match into the Roth. So always contribute up to the match. Then you can start putting into the Roth, or find out from your company. Sometimes, as long as you're putting in, even if you're putting in all 10% into the Roth, you'll still get the match. So we have seen it be company dependent. So it's understanding, don't leave free money on the table. But as Chris has referenced several times, the long-term impact of it. Sometimes when you're younger, it doesn't make sense until we run a plan and see, holy cow, if you don't start making changes now and you just keep jamming all this money in your traditional 401k, it looks nice, but your tax burden is going to be so big.
Right.
That's when if you can map ahead, as we do with our planning and our planning softwares, you can see those ticking time bombs down the road. While that's jarring, isn't it better to find out 15, 20 years ahead of time when you actually do something about it,
Yes.
as opposed to the point where it's already too late, you've got $2 million in your 401k, and it's like, I'm a prisoner and I'm 72 and I got to start taking it. So that's where we always keep coming back to planning, but you can plan in regards to seeing what that future tax burden is doing.
Right.
Okay, now what do we do way ahead of time to alleviate it?
Well, and to your point, so just to presence this for our viewers, if they have the option of a Roth 401k, what you're saying is, let's say someone wants to put away 15% of their income, and maybe the company matches 5%. So what you can do with a lot of plans is put in the 5% into the traditional 401k to get the 5% match, but then you could put the remaining 10% in the Roth, right?
Yeah.
And you can actually put it all into the Roth to get the match. It's just that the match will be in the traditional.
Yes. Okay. Got it.
So-
Yeah.
And Chris is such a great company leader that he does that for us. It's not every company that does that.
No,
though.
it's true.
Some of you have to go, say the match to, you have to go into the traditional 401k to get the match into that. Chris is nice enough, as long as we're saving, it can go, even if it's going into the Roth, you'll still get the match.
Right.
So it's understanding and asking HR or asking your administrator, what is our rule? So you're still taking advantage of the match, but B, getting as much into that Roth 401k.
And you bring up an interesting point there, because there's something called the plan document for a 401k or any kind of qualified plan.
Right.
And the plan document isn't an IRS document. It's a plan document between the company and the plan sponsor or the 401k sponsor that also has to fit within IRS guidelines. So every plan doc is a little bit different.
Right.
One person, let's say the president of the company says, okay, I want to check this box and add a Roth feature. And other companies, the 401k, maybe it's been around for 25 years before the Roth 401k came about, and they didn't check the box because it wasn't available, and they've never upgraded their plan.
Right.
So there's no Roth 401k. Some people are watching this going, Roth 401k, do you mean Roth IRA?
Yeah.
No, we mean Roth 401k, and if you don't have it, it's a box that wasn't checked on your plan, and maybe they can go back and add that.
Yeah.
Right.
So every plan document's going to be different, and I think it's an interesting thing for you to know that if you're watching and you have a 401k, or if you have multiple from old companies, you can go back and look and see what the program was for that 401k, and then either make some changes, or if you're over 59 and a half, most times you can take that money and do what we call an in-service distribution or rollover to your IRA.
Right.
Which is a non-taxable event, but you get it out of the parameters of the 401k rules, and now you have it in the IRA, which we talked about in the previous show.
It opens up so many more
Opens
options.
up so many more
right? You have
options, and you're
control
not
of your own
bound.
money. Yeah,
You got it.
No, that's so huge. Gosh, so much goes into this, and then we only have a couple minutes left in the show. But then there's the withdrawal strategy of knowing which account to withdraw from first in retirement, how much to withdraw from which account. But this is what you help people do as you're building a retirement income plan for folks.
Yeah, because today we spent talking about qualified plans and mainly traditional 401ks and some Roths, but a lot of you might have regular investment accounts. Maybe it was not attached to an employer, or maybe it wasn't an IRA, just money that you're buying stocks or mutual funds. Generally, that's the first one we tap into as we get into that withdrawal strategy, at least in terms of tax efficiency, which we don't have. We're at just a couple minutes left, as you said. We don't have the time to go through all the intricacies, but at a very basic level, we can map out within a plan to see what account do I pull from first so I'm paying the least in taxes, because we haven't met a client yet that loves paying taxes or more than they have to, and that comes back to a plan of how does all this fit together? How can you show me, or we can show you how to strategize where the money's coming from, and that's part of what we call our financial compass process. So you can call the number, you can click the little, what is it called, a QR code, and schedule a time. We'll have a discussion. We'll talk about all these different things, what it means for you, or what's a Roth 401k versus Roth IRA. Any question you have, you've been afraid to ask, we've heard it all. We'll be happy to answer it and see if we can help.
Absolutely. Well, Scott, Chris, it's always a joy to be with you. And the reality is that this might be new to you, but it's not new to Chris and Scott and the team of Bulman Wealth. They are here to help and serve you. This is simply an invitation to have a conversation to see how they can do that. So we invite you, pick up the phone, call that number on the bottom of your screen, 888-970-4685, or scan that QR code in the bottom right-hand corner, and that will get you connected for your complimentary financial compass review. We appreciate you watching, and we look forward to being back with you next week. We'll see you then.